You wake up, grab your coffee, and you check the financial news, only to see that gold has just suffered this massive, grueling 4-week slide.
Oh yeah, it's been a rough month for the metals.
Right, and it's currently teetering right on the edge of this critical, highly psychological cliff at $4,000 an ounce.
Which is just a massive support level.
Exactly. And so to figure out if this market is going to, violently bounce or just completely plummet, we are cutting straight through this week's stack of global precious metals outlook reports.
Yeah, we're doing a real deep dive today.
We really are. We need to find the actual mechanisms dragging these prices down, because once you understand the architecture of this sell-off, well, you can map out your exact portfolio strategy for the weeks ahead.
And I think it's important to state right off the bat that the current setup we are looking at is highly unusual.
How so?
Well, when you dig into the transaction data from just the last 48 hours or so, the market isn't in a free fall anymore, but it's not recovering either. It's basically trapped.
Yeah, I notice a lot of the reports are calling it an accumulation phase, but honestly, looking at the numbers, it paints a picture of total paralysis.
Paralysis is the perfect word for it, yeah.
I mean, gold closed last week at $4,088 per ounce, and as of this morning, it is trading completely sideways, just agonizingly flat.
Right, in that incredibly narrow band between, $4,050 and $4,070.
Yeah. And silver is exhibiting the exact same hesitation, right?
Oh, absolutely. It is moving in lockstep with gold. It's just hovering right between $58 and $59 per ounce.
But the metric that really stands out in all these morning reports, it isn't actually the price.
No, it's the trading volume.
Yes. It has completely dried up. Institutional money has essentially just stepped away from the table.
They're sitting on their hands. And it means gold is currently acting like this tightly coiled spring, just under a massive amount of weight.
Right, because the sellers have clearly exhausted themselves after 4 weeks of pushing the price down.
Yeah, but the buyers refuse to step in and release that tension.
Which really begs the question, right? Like, if the selling pressure has basically evaporated, why are bargain hunters refusing to buy this dip?
Well, simply put, because nobody wants to be the one to catch a falling knife without a macroeconomic net.
Oh, that's a good way to put it.
Yeah, I mean, the psychology of institutional buyers right now is just heavily defensive. They see that $4,000 support level, sure.
Right, it's staring them in the face.
But they also see an environment that fundamentally punishes non-yielding assets. They need a structural reason to deploy capital, and right now, the data simply doesn't support an aggressive long position.
They're waiting for that heavy weight on the spring to actually be lifted.
Exactly. And that wall of weight, I mean, it's almost entirely constructed by the U.S. Federal Reserve.
Oh, absolutely. The Fed is the anchor here because the latest PCE inflation print, which, we know is the metric the Fed watches the closest.
The holy grail of their data, yeah.
Right. It came in at a stubbornly high multi-year peak of 4.1%.
And if we look under the hood of that 4.1% print, the actual mechanics of this market paralysis become really clear.
Because it's not just a blip.
No, not at all. We aren't just seeing temporary spikes. We are seeing entrenched stickiness, mostly in services and shelter costs.
And when you combine that sticky inflation with, we've got solid GDP growth right now and really low initial jobless claims.
The economy is holding up.
It is. So the Fed essentially has zero economic justification to cut interest rates. The economy is just running way too hot for them to take their foot off the brake.
Right. But let me push back on that narrative for a second, just to play devil's advocate.
Okay, go for it.
Because if you look at the broader commodities data, there is a paradox that the market seems to be, completely ignoring right now.
You're talking about oil.
I'm talking about oil. Brent crude is down to $73.38 a barrel.
Yeah, and WTI is hovering near, $70?
Exactly. And energy is the foundational input cost for literally everything in the global economy.
Right, it touches everything.
So if crude oil is plunging that significantly, why isn't this translating into immediate Fed relief? Why is the market acting like inflation is reaccelerating?
Well, see, it is a logical assumption that cheaper oil means cheaper goods. But the transmission mechanism into Fed policy is just much slower.
And that's intentional, right?
Totally intentional. The Fed structurally isolates those volatile energy drops by focusing primarily on core inflation.
Because they know a single supply chain hiccup.
Or a pipeline issue.
Right. A pipeline issue in the Middle East could send oil back to $90 next week.
Precisely. They evaluate the underlying structural inflation. Specifically, they're looking at wage growth in the service sector.
Ah, okay.
So while oil dropping to $70 provides this phenomenal relief for you and me at the gas pump, it doesn't solve the fact that corporate payrolls are still expanding at a rate that sustains really high consumer spending.
Right, so until the labor market actually cools, that structural inflation remains.
Exactly, meaning interest rates stay highly restrictive.
Which brings us to the actual mechanism punishing gold this morning, the opportunity cost.
Yes, the 10-year U.S. Treasury yield. It is currently sitting at an incredibly high 4.382%.
And that yield is just the gravitational pull dragging the entire precious metals sector down.
It really is.
I mean, think about it. If you manage a billion-dollar sovereign wealth fund, or say, a pension fund, your primary mandate is to generate yield to meet future liability.
Right, you have to make a return. And gold, despite its historical role as a store of value, it generates zero yield. It just sits there.
Exactly. So when the U.S. government is offering you a guaranteed risk-free return of 4.38% just for holding a 10-year bond.
Capital allocators have a literal fiduciary duty to rotate out of shiny metals and into fixed income.
The math is inescapable. And that high-yield environment also aggressively bids up the value of the U.S. dollar.
Right, the DXY.
Yeah, the dollar index is currently showing massive strength at around a 101.37.
And since gold is globally priced in dollars, a surging DXY makes gold mathematically more expensive for buyers in, Europe, Asia, emerging markets.
Which immediately suppresses global physical demand.
But hold on, let me stop you there. You say the dollar is acting as this massive headwind at 101.37.
Yeah.
Historically, though, we have seen gold rally alongside a strong dollar during periods of sovereign debt crises.
That's true, we have.
And the U.S. is carrying a historic multi-trillion-dollar deficit right now. Why is the market completely ignoring those catastrophic debt fundamentals and continuing to just pump up the dollar?
It's a great question. It really comes down to the timing of sovereign debt realization versus immediate yield capture.
Meaning
institutional money prioritizes what is happening in the next quarter over what might structurally break in the next decade.
Ah, right. Short-term thinking.
Exactly. In global foreign exchange, the dollar is currently viewed as, well, the cleanest shirt in the dirty laundry basket.
I love that analogy. The cleanest dirty shirt.
It's true. Yes, the U.S. deficit is massive, but compared to the economic stagnation in the Eurozone.
Or the structural real estate crisis in China.
Exactly. Compared to those, U.S. debt still offers the most liquid, highest-yielding safe haven on the planet.
So the market will eventually price in that debt crisis, but today they are just blindly chasing that 4.38% yield.
You got it. And that makes the geopolitical unwinding we're seeing even more painful for the gold charts.
Oh, yeah, because the reports indicate that tensions in the Middle East have actually cooled significantly since mid-month.
Right. And when you combine fading fear with those high yields, the safe haven premium that drove gold to record highs earlier this year is essentially just draining out of the asset.
Yeah, funds that bought that geopolitical breakout back in Q1 are now just locking in those profits.
Which adds this heavy layer of structural selling pressure to the market.
So we have this massive wall. High yield, strong dollar, and profit taking. That is exactly why the market is paralyzed today.
But paralysis implies tension, and tension eventually breaks. The trigger for that break is sitting right in this week's macroeconomic data dump.
Yes, because if the market is hyperfixated on the Fed and the Fed is hyperfixated on the labor market,
this week is an absolute powder keg.
We are looking at a brutal gauntlet of U.S. labor data. We've got the JOLTS report showing open positions, the ADP private payrolls.
And most importantly, the non-farm payrolls.
Right, which is actually releasing early this week ahead of the U.S. Independence Day holiday.
The entire trajectory of gold for the third quarter hinges on this exact sequence of reports.
Okay, break that down. How does that mechanism work?
It's straightforward, really, but it's highly binary. If we see a strong labor print, say, non-farm payrolls significantly beats expectations and unemployment stays flat.
Then the Fed has all the runway it needs to keep rates at these restrictive levels.
Exactly. The dollar strengthens further, bond yields spike, and gold likely crashes right through that $4,000 psychological floor.
Ouch. But the inverse scenario is where that coiled spring we talked about violently releases.
Oh, absolutely. If the JOLTS report shows job openings collapsing and the non-farm print severely misses expectations,
then the narrative completely flips.
Instantly. Suddenly, the Fed is staring at a deteriorating labor market while holding rates at multi-year highs.
The market will instantly begin pricing in emergency rate cuts to prevent a recession.
And the moment institutional algorithms sniff an impending rate cut, the transmission is immediate. The 10-year yield plummets, the dollar index breaks down, and capital rotates aggressively back into gold.
It's crazy how fast that can happen. But, while everyone is holding their breath for the labor data, these outlook reports highlight two massive structural wildcards bubbling under the surface.
And both of them are tied to the tech sector, which is fascinating.
Yeah, let's talk about the AI bubble first. We have seen astronomical, historically unprecedented valuations in artificial intelligence companies over the last couple of years.
It's been wild to watch.
So if that bubble undergoes a severe correction, what does the capital reallocation actually look like?
Well, when a hyper-growth sector, like AI, experiences a violent mean reversion, institutional capital doesn't just sit in cash.
Right.
Risk parity funds and massive asset managers are basically algorithmically programmed to shift capital into uncorrelated assets.
So during a severe equity shock, liquidity traditionally flees to the safety of U.S. treasuries and gold.
Exactly. And even just a 5% allocation shift from boosting tech equities into precious metals, that represents hundreds of billions of dollars flooding into a relatively small physical market.
Wow. Which introduces the second and honestly arguably more fascinating tech variable here, silver's structural deficit.
Oh, this is a hidden story of the decade.
Right. We habitually lump gold and silver together as just precious metals, assuming they just react to the same macroeconomic crosswinds.
But silver has an entirely different demand profile.
It does. It is a critical industrial component for the energy transition and next-generation computing.
And the physical realities of silver are completely divorced from the paper trading market right now. Well, the macroeconomic noise of Fed policy dictates the spot price today. But in the background, we are looking at a multi-year structural deficit.
Meaning we are using more than we are pulling out of the ground.
Exactly. Global mines are extracting less silver than the industrial sector is consuming.
And the reports point specifically to the rapid deployment of solar infrastructure, right? Electric vehicles, AI hardware.
All of which require highly conductive silver paste.
Yeah.
The transition from older solar cell technology to newer N-type cells requires significantly more silver per megawatt.
And we are talking about staggering physical gigawatt deployment globally right now.
Right. So at a certain point, the macro headwinds of a strong dollar become totally irrelevant to a solar panel manufacturer. They physically need the metal to keep their factories running.
That baseline industrial demand creates a remarkably hard structural floor for silver prices over the long term, regardless of what the Federal Reserve does.
Precisely. It's a completely different dynamic than gold.
So if we take all of this macroeconomic theory, the Fed's stubbornness, the AI wildcards, the labor data powder keg, and apply it to an actual portfolio strategy this morning, the reports present a very stark divergence between short-term risks and long-term accumulation.
They really do. The immediate tactical outlook is categorized firmly as bearish to sideways.
The consensus across the analytical desks is that gold has not yet established a definitive bottom.
No, meaning the $4,000 floor is going to be heavily stress tested in the coming days.
Highly likely. Some of the quantitative models we looked at suggest the price could easily wash out down to like $3,960 per ounce in the near term just to clear out week-long positions.
And for capital allocators to actually believe a new bull market has begun, they need to see gold break back through the $4,150 to $4,200 resistance band.
And crucially, it must be accompanied by massive trading volume.
Right, because a low volume bounce is just a technical dead cat bounce. It doesn't mean anything.
So the next few weeks could be incredibly choppy. Yet despite this grim short-term forecast, the long-term outlook across every single one of these global reports is aggressively bullish.
Which is such a contrast.
It is. They argue the multi-year upward cycle for precious metals is fundamentally intact.
And this comes down to the absolute most powerful force in the global gold market right now: sovereign de-dollarization.
Yes.
We mentioned earlier that retail and institutional investors are selling due to high interest rates. But the ultimate whales, the global central banks, are aggressively buying.
And the reports note they are doing this largely through OTC or over-the-counter markets.
Which is a crucial distinction.
Right. Why does that specific mechanism matter to, say, the listener who is just looking at a spot chart on their phone?
Because OTC transactions are bilateral agreements. They don't immediately broadcast to the public exchanges like the COMEX.
So they're hidden.
Effectively, yeah. Sovereign wealth funds and central banks are quietly vacuuming up thousands of tons of physical supply completely off market.
So a retail trader looking at a red daily candle on their trading app sees wildness, completely unaware that a central bank just locked up massive physical tonnage in the background.
Exactly. This silent accumulation creates a sort of subterranean foundation for prices that the paper markets eventually just have to reconcile with.
Okay, let's translate all of this into actionable scenarios for the listener. Say you are currently sitting on a significant allocation of physical gold.
Okay.
You have watched the spot price slide for 4 consecutive weeks, and the prospect of it testing $3,960 is looming. What do you do?
The unanimous, mathematically driven recommendation from the analysts is to hold the position.
Hold.
Yes, because
Yep.
there is a critical disconnect right now between paper spot prices and physical reality.
Right. Domestic, local prices for physical coins and bars fall much slower than the global spot price flashing on the screens.
Largely due to dealer premiums.
So if you capitulate and sell your physical holdings during this dip, the spread and the premiums will make it punitively expensive to buy back in when the macroeconomic trend inevitably reverses.
You'll just bleed capital.
Okay, what about the inverse scenario? Say you are holding cash on the sidelines, waiting for an entry point. At $4,050 this morning, is this the moment to deploy?
For long-term cash allocators, the mandate is absolute patience. You do not step in front of a moving train
You wait for the market to establish that higher low.
and confirm the reversal with volume. Now, for active day traders, the reports do discuss a strategy of surfing the waves, basically exploiting the short, sharp technical rebounds that occur within a broader downtrend.
But that requires immense precision, and it introduces a severe warning highlighted in the research.
Very severe.
They specifically emphasize the dangers of utilizing high leverage in the current environment.
Oh, a sideways, volatile market is an absolute graveyard for leveraged positions.
They'll just get whipsawed.
The chop will trigger stop losses in both directions, slowly bleeding an account through theta decay and margin calls.
Which really highlights the most pervasive psychological trap the reports warn against, which is recency bias.
That's the killer. The human brain is hardwired to look at a 4-week slide and assume the asset will just go to zero.
Or look at a breakout and assume infinite gains.
Right. It is the complete destruction of objectivity. Successful capital allocation requires actively fighting that evolutionary instinct.
So when the price is plunging, you must evaluate the structural mechanics, like the central bank buying and the silver deficits we talked about, rather than just reacting to the red pixels on a screen.
Exactly. Risk management dictates preparing for that $3,960 washout while simultaneously positioning for the eventual Fed pivot.
So bringing this massive macroeconomic puzzle all together, the precious metals market this morning is basically frozen in tension.
Frozen solid.
It is trapped between $4,050 and $4,070, suffocated by a 4.38% Treasury yield, a dominant U.S. dollar, and sticky service sector inflation.
And everyone is sitting on their hands waiting to see if this week's U.S. labor data forces the Federal Reserve to finally blink.
Yet beneath that heavy layer of short-term macroeconomic gravity, the long-term structural architecture of the market has rarely been stronger.
It's true. The physical supply deficits in industrial silver and the relentless, quiet accumulation of gold by global central banks, they provide a formidable safety net against total capitulation.
And honestly, understanding this architecture is the ultimate inoculation against market panic.
Right, because when you recognize that today's price drop isn't a fundamental failure of the asset, but rather just a mechanical reaction to bond yields and algorithmic profit-taking, the fear sort of evaporates.
You stop being a victim of the daily news cycle, and you start viewing your portfolio through the lens of structural reality.
Which leaves us with a really profound disconnect to consider as we wrap this up.
Go on.
On one side of the market, you have everyday retail investors and leveraged day traders capitulating. They're terrified by a single sticky inflation report or some hawkish comment from a Fed governor.
And on the other side,
you have the most deeply resourced, highly informed entities on the planet, global central banks, using this exact period of retail panic to quietly load thousands of tons of physical gold into their sovereign vaults.
wow.
It forces a fundamental question about the timeline of wealth, right?
Yeah.
What exactly do the central banks know about the instability of the next decade that the day traders are completely missing?
It's an incredible divergence between those who print the fiat currency and those desperately trying to trade it.
A massive structural shift to watch as this week's data unfolds.
Absolutely. Well, that is all the time we have for today's deep dive into the precious metals market. Thank you for exploring the mechanics with us and for getting smarter about your portfolio today. We will catch you next time.